A contract is needed not in the beginning when things are hunky-dory. A contract is needed when things don't go as planned.
Gideon Pfeffer serves as
CEO and managing partner of the GSH Group,
a company that's currently valued at more than $1 billion.
And assembled a portfolio of over 7,500 apartments in 5 states.
Most people can make money in an up market, but you choose a sponsor really for how they're going to respond during a challenging time. I always have to cater to the idea that there's one investor in this one deal who's not in any other deal, and be somewhat redundant from that perspective. Because interest rates are much higher than what the rate caps are today, like we can get out and get our investors' money back and create opportunity for better yield, trying to make the best fiduciary decisions for our investors in those deals.
I want to partner with institutions. What advice might you give there? You've assembled a massive portfolio in 5 years, 9,000 or 7,500 units, $1 billion worth of assets. And when I hear that now, I think of, bridge debt, high loan to value, stuff that right now might create distress. What's your portfolio look like today?
Thanks for jumping right in on that, because that's what I'm dealing with day to day, obviously.
Me too, as a multifamily investor. Absolutely, me too.
Thankfully, I would say about 65% of our portfolio is locked into long-term, low-interest, fixed-rate debt. Thank God. And that's kicking off great preferred returns and distributions to our investors. There's about 6 properties that we bought at the end of the run-up, second half of 2021, first quarter of 2022, all on bridge debt that are challenging. That's taken up, 80% of my team's time and focus. And then what is the plan? Sell, refinance out, and really just it's less about maximizing profit on those properties, unfortunately, at this point. It's more about preserving ours and our investors' capital and mitigating losses to the best of our ability.
Well, that's the role of any syndicator, right? When you think about it, we've had a great run, meaning not we, you, me, but the market has had a great run for operators since 2010, really, 2011, really. So, it's always been up and to the right. But the true role of an operator, a steward of money, is to provide a return during, good economic times, bull market, if you will, and then preserve capital in a bear or recessionary market. So that makes sense to me. Can you give me a sense of, with that 35% of the assets that you're still trying to figure out, are they salvageable? Do you have enough equity in these deals? Can you sell them and still return investors at least their initial capital? Or do you have any assets right now that you're saying, we might be at a loss on one or two of these?
Yeah, sure. And I'm happy to talk about this with you because, like you said, I liken it to the analogy of like a contract. Like a contract is needed not in the beginning when things are hunky-dory, right? Mm-hmm. The contract is needed when things don't go as planned. So I liken that to a good sponsor, right? Sponsor is most people can make money in an up market, but you choose a sponsor really for how they're going to respond during a challenging time. And so what I'm doing and my team is doing on a regular basis, we're doing like quarterly webinars for every property that's not going according to plan. And we're great at communication. We do monthly property updates on every single property in our portfolio because we syndicate deal by deal. So it's not structured like a fund. So we've got different investors in different deals. And so I always have to cater to the idea that like there's one investor in this one deal who's not in any other deal and be somewhat redundant from that perspective. So we do monthly property reports. We do quarterly in-depth reports. And I've been doing webinars on a quarterly basis, kind of like a quarterly earnings call. And our investors really appreciate it. Because I think that when they're not communicated to, I know when I'm not communicated to, I start assuming the worst, right? So people just appreciate transparency, and they want to know that as their fiduciary, you and your team are doing as much and everything you can to protect their underlying investment. Overall, like I said, there's 6 properties that I'm dealing with. There are 2 that got perfect storm of higher than expected operating costs due to inflation, interest rates going way, way up, higher and quicker than any of us expected. And then the third, which is the killer, is, in certain municipalities across the country, there were massive delays in being able to evict people. I've got 2 properties, one in Maryland, one in Michigan, where I literally couldn't evict people in 2022. 2022 is literally just a lost year. but obviously we know we still have to make debt service payments. So I'm raising extra equity on those two deals to get us through stabilization to sell in 2024. I'm raising that money kind of kind of like a preferred equity structure, but rather than going out to the market for rescue capital, I like to be in control, so I'm raising it myself. The new money has significantly better economics than the original investors' equity, and those two deals were really just trying to get our original investors' money back at a nominal rate of return. The other four, there's a couple that I think, because interest rates are much higher than what the rate caps are today, like we've got some runway to see where the market goes. If we sell today, we sell kind of at a par, which isn't a bad thing in today's market. I can't believe I'm saying that. Like I would never have said that 2 or 3 years ago. But yeah, if we can get out and get our investors' money back and invest in something that can create opportunity for better yield, I think that's a win for folks. And I've got a couple of properties where I'm just not sure. We're still working through it, where a rate cap's expiring in December. So I have to decide, do we sell and take a little bit of a loss, or do we refinance and get mezz debt because we can't cover the gap of our existing mortgage amount? And that mezz debt is expensive, Does it make sense to trap out all of our invested dollars for the next 5 years and not pay distributions and just be continuing to accrue pref and mezz? Or do we just sell at a little bit of a haircut so we can move on into newer investments that yield, and trying to make the best fiduciary decisions for our investors in those deals?
Talk to me about buying criteria. I'm sure it's morphed. I'm sure you've gotten more sophisticated as you've dove in from 2017 to 2018 to 2019 and so on. But when you're buying a deal, and I know you're across multiple states, Michigan, Ohio, Florida, and others, Maryland, you mentioned, what are you looking at? I think you mentioned before you buy workforce housing. Define what that is for you. And what is it that when you buy a deal, what are some of the criteria you're looking at as far as, do you have to be, below market? What kind of debt do you typically put on it? Is it all bridge to start? Kind of give me an idea of like the standard deal circa 2020, 2019. Tribe listeners, I have an extremely exciting announcement for all of you. Do you want to come hang out with Cody Sanchez, David Osborne, David Green, Rich Roll, and even yours truly down in Austin, Texas? Well, let's do it. May 1st, 2nd, and 3rd, for the first time ever, GoBundance, the exclusive millionaire membership group, is opening up an event to anyone, man, woman, millionaire or not, and we're calling it the Austin Entrepreneurial Summit. At the AES, you'll meet all those people I mentioned, plus GoBundance members on both the men's and women's side, and I'll be there hanging out the entire time. Every event I've ever attended for GoBundance has given me a disproportionate return on the money spent and the time spent to get there. And this is the biggest one that GoBundance has ever done. So if you're a member, not a member, and you're looking to supercharge the second part of your year, 2024, this event in May is a great way to get that all kickstarted. Go to GoBundance.com/AES right now for early bird pricing for members and guests. And warning, the power of GoBundance events is that it holds you accountable long after you're gone to achieving whatever goals you've set. So this event will change your life. GoBundance.com/AES. I'll see you there. Let's get back to the show.
Okay, so this is the criteria based on 2019, 2020, right? Not today. All right.
Correct. Yeah. As you were buying then. Yeah.
Our portfolio is pretty heavy in Michigan, right? So Michigan is nuanced. It's not a super high growth market necessarily, but people live here and people pay rent. We're in Ohio, Indiana, Maryland, and Florida also, but that kind of that Midwestern flavor, can we get a good cash on cash return and a good IRR in some sort of hypothetical sale 5 to 10 years from now? So for us, it was always about cash on cash return. A lot of our investors have been historically more income driven than IRR driven. Our typical investor profile has been, higher net worth individuals who have a business that makes them money or are retired, and they don't care about getting the money back that they're investing with us. They want that income stream. Yeah. So it was always about a well-located property on the right side of any invisible dividing lines where we believe we know where the replacement tenants are coming from. That we believe that we can elevate and create more value in. So we bought properties that were really well maintained, but just needed to be freshened up. The colors were more like yellow and brown, and we just needed to turn it into white and gray. So it was paint and carpet. To real heavy value adds where there was high delinquency, amenities hadn't been taken care of for a long time, where we were going in and spending, $5, $7, $10, $15 million on renovating every unit, upgrading all the amenities in the clubhouse and rebranding and really completely turning a community around and making it brand new. Um, from going back to a underwriting perspective, during that time period, 2019, 2020, and before, I was never really a cap rate buyer.
Mm,
I was more of like, do I believe that I can create value in this property? Because at the time, buying at a cap rate, in a market that was kind of all over the place, you're basing it on the previous owner's performance, right? And if we believe that the previous owner or manager was less efficient or creative than we were, then it didn't make sense for me to be a stickler about a cap rate, right? I mean, in 2017 I bought uh, a 408 unit property in Michigan. You're a Michigan guy. It was in Harper Woods, but at Grosse Pointe Schools, which is a
mm,
big draw.
right.
I bought it for like $65,000 a door, which people thought was crazy, and I bought it at a 4.55 implied cap rate. And I was early on in our syndication journey, and I did talk to some larger like JV groups, equity groups, who were like, "There's no way that we would ever put money into this type of a cap rate." I think at the time I raised about $12 million for it, which was a lot for us at the time.
Sure.
Um, and I can't, it's sticking out as 7 million or 12 million. It was one of the two, but it was our third deal that we bought as GSH together. Um, but the owner had owned it for 20 years. They had maintained it well, but they didn't really do any upgrades. And they were a family kind of generational type of owner, and they cared more about occupancy than rental rate, right? Like we love those types of deals, right?
Yeah.
So we ended up buying it, and we elevated the property somewhat. We didn't do an overwhelming amount of work, but we brought it up to market rate. They were doing a ton of concessions that were not necessary. We burned off concessions. We tightened up expenses, and we ended up selling it and doing really well on it. Right. So if I had listened to people about cap rates, and not bought it, that would have been a mistake. Somebody else would have bought it and done well.
What was the exit cap rate? What would that have calculated out to be? Do you recall?
I think we sold it at the end of 2020.
So you said 65 a door is what you bought it for, right? 65 a door?
We sold it for upwards of 100 a door. It was pretty strong.
Yeah. 3 years, right? 3-year reposition.
3 years, yeah, in 3 years.
Wow, that's pretty good. Okay. Michigan's got I don't know, migration problem, right? So I think U-Haul stats show that Michigan's the third most exited one-way rental state for U-Hauls. And look,
Yeah,
being a guy from Michigan, people say, oh my God, the state's dying. I'm like, well, there's also inward migration, meaning, you rent from, say, Detroit or downriver, and you're moving where I am, Brighton, Howell, those areas, right? So there's migration to other parts of the state. You have a big portfolio in Michigan, you mentioned. Where are you mostly focused? What markets within Michigan, submarkets within Michigan are you buying?
so we're in southeastern Michigan is where we're headquartered, metropolitan Detroit, and we're in kind of the more mature. When we started our portfolio journey, we kind of were just buying whatever we could get our hands on because we were new, right? And we were
Yeah.
untested, and it was very competitive. And when we're starting out, you kind of just need to get units under your belt. Over the course of the first 3 years, we were always our goal was always to grow our portfolio. We were net buyers rather than sellers, but the properties that we exited, we pruned our portfolio is what we called it. We
Yeah.
pruned it. We pruned properties that were maybe not as well located for the long term as we would prefer. And what that means, well located, what does that mean? Just like maybe the resident base is more affected when there's a recession. Maybe there's a little bit of a higher volume of turnover, or maybe it's just a little bit more difficult to manage, right? So we want to make our lives as easy as possible. So we graduated out into the Canton, Farmington Hills, Waterford, Grand Rapids, which is on the west side of the state, which is competitive. It's like a whole different market outside of Michigan, right? It's like as competitive as a lot of national markets because of population growth and business growth and cost of living and et cetera, et cetera. So um, places with high average median incomes, places with good employment and good schools that are safe, kind of just the typical real estate 101 things that you try to do once you're able to be more competitive in a market environment, when you can get brokers and sellers comfortable, that you can compete with other larger owners and maybe even institutions that are looking in the area. If you can stand toe to toe with them, you can start focusing in better markets.
When you were buying back in 2019, 2020, talk about debt terms generally. I'm sure each deal had something unique to it, but were you mostly locking up with higher loan to value bridge type debt? Were you more, long-term debt with extensions and lower loan to value? Give me an idea of how you would approach debt when you were acquiring back then.
So when we started, we were doing a mixture of fixed rate and bridge debt depending on the property. But for the most part, we tried to purchase with fixed rate debt as often as we could. And our underwriting modeled out, well, maybe, once we stabilize this property and elevate the NOI, we'll do a supplemental loan or some sort of strategic finance, like a refinance or something, maybe in year 5 or 7, and return all or a portion of the equity. Relatively successful in most of our, that 65% of our portfolio that's locked in. Most of that debt is not the first loan that we took on it. For a couple properties it is, but we've had some relative successes where we got into fixed rate debt and interest rates went down, and it made sense for us to lock into even lower interest rates and just pay defeasance at the time. And a few properties that we did do on bridge that we locked up fixed rate debt. There's a guy that works for me who's 20 years older than me and has been through a few cycles here. And when COVID happened, on all the properties that were not in fixed rate debt, he urged me to get everything locked up into fixed rate debt, and we did that. Thank goodness. At the time, those rates were low threes.
Yeah.
Because we didn't know what was going to happen, right? So we locked into fixed rate debt, and that's been really good for us.
We had a property I regret selling in Pinckney. It was a small property, 16 units, but we were at 2.99 locked in. It was just stupid debt, but is what it is. A partnership kind of fell apart, so we exited the asset. But yeah, no, that makes sense. I'm curious with the Fed's. Oh, go ahead.
I was going to say, there's one deal that we were purchasing where we were planning on getting agency financing. It was our biggest deal with debt to date. In 2019, we were buying 717 units in Oak Park, Michigan. We wanted 75, 76% LTV, and 30 days in, we were only getting 70%. So we ended up going on more of a CMBS route, but it was through Arbor, who we have a great relationship with, and they had a private label deal that got that they would package up and sell on the back end. That was at 4.95% plus a mezz piece to get us up closer to 80%. But last year we refinanced out of that into the low threes. That's probably one of my best deals to date, where I literally refinanced into a lower aggregate interest rate. We took out $20 million, and our mortgage payment went down every month. I returned 121% of the equity to my investors. And so now we're just in the money and in our promote. I wish every deal was like that.
Yeah, sure. That's incredible. What town or market was that in?
That was Oak Park, Michigan. So that was it's literally on the corner of Greenfield and 696.
Got it. Very cool. Well, actually, I was going to ask this. So you talked about, 65% of your assets are in fixed rate debt. Is there, the Fed has signaled they're going to have 2 more rate hikes this year, right? A quarter point each time. At least that's what they're saying. I think they're going to hold for a period of time, but they'll come down at some point. Something's got to break. There's 6-9 month lag after each of these rate hikes. So sometime in 2024, 2025, we'll see something, I'm sure. But, who knows? For you, is there a year coming up in the next 2 or 3 where you may be facing something similar? You got these 6 assets that you're dealing with. You got fixed rate debt on the rest of them. Do you have a number of them coming due in a certain year in the near future, or is it sort of staggered with the remainder of your portfolio?
Yeah, I don't think that there's any debt that I have that expires sooner than 2028 or 2029. We did 10, 12, and 15-year debt on those.
Smart. Yeah.
So I mean, and I appreciate you saying smart, but there were times between 2017 and 2021 where I wished that I had taken out, agency floaters, because when I refinanced into lower fixed rate debt, I paid decent defeasances, or when I sold, you know, so strategically speaking, and I got in at when I did a lot of single family work prior to
Yep.
2017, few thousand houses. So I understood residential real estate investment. I understood construction, but I was a little green from a multifamily and a large scale multifamily perspective. And I got in. Some people were saying in 2017, "Are you sure you want to buy multifamily? We may be at the top of the market," and that freaked me out. Um, Thankfully, I pushed through that fear and purchased. But getting into like short term stuff, I was always kind of cautious about, especially because we wanted to build a portfolio and our investors cared more about cash than exit. On the next run, we'll probably be a little bit more strategic on an asset to asset or market to market basis with debt and terms as it relates to length, based on the business model for each
That makes
property.
sense. I was going to ask what you've learned and what you might do differently. And let's bring that forward. So today, you haven't bought in a while, I know, but what are the criteria today as you underwrite deals and look at deals? Like, give me some of the, not from a debt perspective, from a asset type perspective, from a market perspective, and everything in between. What are you looking at today, and what is in your buy box?
So we bought one deal in the first quarter of this year in Grand
Oh, you did.
Rapids. It was a brand
Yeah.
brand new, delivered in 2022, 320 units, just like most beautiful property in my portfolio at this point. And got what I thought was a fair deal at the time. Maybe did a little bit better than because of kind of just the dislocation in the market at the time.
Yeah.
But before that, I hadn't purchased anything uh, since the second quarter of 2022. And we're looking at a lot of stuff today. And, I don't want to sound overly like pessimistic, but we used to push deals. We used to be aggressive because we knew we had a comfort about our operation and what expenses cost and where we could push rents. And we've got a little bit more caution today as it relates to really what are the non-controllable expenses, really, like what are property taxes really going to be, what is insurance really going to be, how much is payroll really going to be, um, and how much can we really push rents realistically in today's market environment. um, we're seeing softening on occupancies, we're seeing softening on rents in our portfolio. um, and I'm just still not seeing, it's just not a time to be aggressive on deals, right? So like our buy box has not necessarily changed, but our caution and our understanding of the reality of what it really costs to operate a property is much more elevated, because of our experience and because of our portfolio. So we're not in today's market environment, not taking as many chances maybe as we would in the past, partly because of knowledge and partly because we've got enough headaches to deal with right now. I don't really want to deal with any more, so, and then there's this perception that more distress is coming, right?
Yeah.
um, and so, now's not the time to push, and more distress might not come. I mean, frankly, like I think that perhaps that there's a chance that the paradigm for multifamily investing has potentially shifted. I'm not hoping that it has, but the days of like getting into a property and having a relatively strong cash on cash return right off the bat, or being able to elevate a property to a 10 average cash on cash return, or in 5 years exit at a 18 to 20% IRR. There's a lot of question marks in my mind about the reality of that right now. And part of it I think is because like you said, interest rates have not stopped. Like we're not done, right?
Right.
The Fed hasn't said we're done, right? And until they do, we can't really make educated guesses on where cap rates are going to settle out at. So there's still this inherent, from my perspective, there's still this inherent dislocation between what sellers want or need or expect from a sale price, per unit price, cap rate, whatever, and what buyers think they should be getting based on all the things that I've said before, the cost of operating, or what we think units are worth in today's market. And so that's why we're not seeing a ton of deal flow. We're not seeing I think listings are down like 70% year over year, in the multifamily space. And I think it's going to kind of be like this until the Fed says it's done and we can kind of realize what the new normal is from an interest rate and cap rate perspective is.
Makes
And then
sense.
that paradigm shift is like, what's the new return profile, right? I mean, units
Well,
cost
there you go.
more,
Yeah.
interest rates are higher, expenses are higher. And so I think that, I don't know, I mean, I think that we're going to all have to educate our investors a bit more about what the new reality is in terms of what multifamily being a safe and for a little while longer, a really great tax play, but the returns that we're used to, might be coming down a few points.
I think what this is doing too is it's resetting, to your point, just mass expectation for what a good return is. There's just been
Yeah.
so much noise in the market over the last few years. And look, I'm a genius multifamily investor because I started at the right time, right? We all have been geniuses in the last 6 years.
Mhm.
Some are being
Mhm.
exposed, some are not. Knock on wood, I'm not, you're not. But to your point, there's
Yeah.
going to be deals that go south. It's a matter of, do you communicate, do you not? I think that's where you see the real rubber meets the road. Like, an investment is risky by nature of being an investment. So if a deal goes south, but the operator is sound, that to me is, hey, look, sign of the times, right? But
Right.
the expectation of a 30, 40 IRR on this sort of asset or this land deal is going to double it's just, I like the sex appeal of a 15 IRR and 8% annual cash on cash. Like I think people have to really understand that a lot of people who have been doing this for a long time were saying, look, I've been doing this forever. How in the hell am I getting outbid and everything? How is it that I'm not able to buy these deals anymore because I'm returning a conservative, let's say, compared to many others, return? But I think we're finding now,
Right.
like, actually, that's probably healthy. That's probably a normal way for investors to look at it. Like, oh, okay, steady as she goes, good return. I'm going to get my money back plus, in a couple of years here, 4 or 5 years. That's the way to invest. And I think that's finally, I don't should say finally, but I think we're just learning now that is actually what a good deal is, as opposed to trying to shoot for these moonshots to get a massive return, which just, I don't know, it doesn't shake out in this kind of market. So
Yeah, you're right. And the only other piece of my underwriting criteria that I think has shifted is that we're really focused on and doing a lot of research and learning about growth markets, right? So, I've got a property in Orlando, I've got a property in Tampa,
yeah,
we're in Maryland, but it was always so competitive down there, and the return profile right out of the gate was so low and risky. We just stayed where we were comfortable and where our investors, we were like a big fish in a small pond in Michigan, and we did really well throughout my career, even in single family, in doing properties in Michigan. It's you're pushing a boulder up a hill,
yeah.
the wind is at your face, it's not at your back. And so on the next round, we'll still buy in Michigan because we understand Michigan, right? But we're also going to really hit markets heavy that just have population growth and have job growth, and where, like I said, the wind is at our back a bit. That'll help us along, where it's not just operationally we're improving NOI, we actually have economic fundamentals around us that are also helping us. And we didn't really play like that in the past. That's what institutions do. And if we can just get a small piece of some of these larger markets, then, I think we'll be successful in that as well.
It's the old real estate adage, right? Location, location, location. So
Yeah.
you mentioned institutions, and you've got some history of working with institutions. I think you acquired a 700 unit portfolio of houses at one point, individual single family homes with an institutional partner, we'll say.
Yeah.
Are you seeing opportunity there now? I mean, you mentioned growth markets. I think a lot of the reason why growth markets are sort of doubly good is, one, there's population growth, and two, no one's selling their houses. Interest rates, my house is locked in at 2 point something percent. I'm not selling my house.
Yeah.
The debt's just too good, right? I'm not going to sell and get a 6% interest rate on something. There's a constraint on supply, along with still a delay in development from '08. And then, as it was getting momentum, 2020 kind of stifled development as well. So I think that plays really well for multifamily in growth markets. One, you have growth, and two, you have constrained supply. At least that's what I see. And you can tell me if you think I'm wrong or not, please do.
No, I think you're right.
But the other side of that is the SFR market. I mean, maybe I'm misreading, but the BlackRocks of the world, they're really going heavy, or had been going heavy into that market. And you've got a history of not only the SFR market, but also dealing with institutional partners. Is that an opportunity still for you? Do you ever look at that? I know you're in your lane with multifamily, but do you ever think of pivoting back? Is it the right time to, or just for anybody out there, is it the right time to start looking at, building institutional partnerships to go after the SFR market?
It's a great question, and there's a couple facets to it, right? So first, I heard institutional, right, and I think that cuts both ways, both for SFR and for multifamily, because we haven't taken
True
institutional checks, right? That 350 million that we've raised has all been smaller check sizes, but all accredited investors, which I prefer because I maintain all the control and can charge what I charge. SFR, look, I've had moments over the last few years where I've asked that question because, with the blow up of or with the expansion blowing up in a good way with build to rent, in 2013, I was doing build to rent deals. Like I'm sure my partner at the time and I were not the only people doing it, but when we were aggregating back in 2012 and 2013 in Atlanta and in Houston and in Dallas, Florida, we were, that scene in The Big Short where Steve Carell and his guys are doing due diligence and they're walking through properties and developments in Florida that just there's nobody living at these properties. That was the truth. Like I did that, and not only did we do that, but we went to developed like subdivisions with developed lots that might own, like there might be 150 developed lots and like 3 houses built, literally, right? And these developed lots that cost $40,000-$50,000 at the time, just to develop underground, to go vertical. We could pick those up for $5,000-$10,000 a lot. That's how much the water tap fees were. You know what I mean? Like we could get the whole developed lot. So what we were doing, and these builders couldn't build because their model was a mortgage, a buyer who's going to live there would go and get a construction loan for them to build, and then they would move into the property, right? So their buyer couldn't get a mortgage for them to build. So what we did was we paired institutions with these builders who controlled the lots, and we made arbitrage in between that contract. And we did probably almost 1,000 build to rent houses back then like that. And I just made a fee off of every single one of them. And then we aggregated options on 2,000 build to rents between Nashville, the Carolinas, Georgia, and I think Texas. And I shopped it to Starwood, a few different institutions, let's just say that. And they were all like, we love this, but they just like, they weren't sure yet. Right. It just wasn't a thing yet. And I was like, we just kind of threw our hands up and like moved on to other stuff. And then and then I saw it blow up, and so I always feel like, I'm missing the mark. I can do that type of thing. It's a lot of work, SFR, for those of us who've done it or are still doing it. It's incredibly rewarding, but it's a lot of brain damage. And I feel like my lane is like full enough today. Right. And maybe if it was like 2021 again, and I wasn't dealing with some of the challenges that we talked about in the beginning of the podcast, I might feel like I and my team have some additional bandwidth to like explore things like SFR. But I think right now, like we're probably full. And at the same time, though, like as we're exploring new market environments or locations to invest, if those deals come to me, like I know how to look at them, and I would consider it.
Okay, that kind of prompts a question. Institutions, you mentioned a moment ago, they go for growth markets. So that's something you've taken from sort of observing the big institutions. And as an aside, we've had this conversation within GoBundance. When you think about it, right, like this space, raising big money and everything else, it's really reserved for, sophisticated finance, Harvard, Syracuse University type of folks, right? Like yourself. And there's so many people that got into the space in the last few years, just like, I raised $5 million, I raised $10 million from friends and family. And a lot of those deals are going bad, right? So for you to have the relationships and the observation of what institutions are doing right now, what do you see aside from growth markets being, maybe the play of what they've done historically? What do you see in the multifamily space? What do you see in the build for rent space? Because I think I saw something like a year ago, 2% of build for rent was institutions represented 2% of the build for rent market. Now it's like 40. Right? They've gone crazy. Maybe it's more than that at this point. So for the person listening, for the investor out there who's sort of saying, okay, I'm on the sideline. I've pruned my portfolio. I'm a cash heavy. I did all the stuff the right way going into what we're in now, a bullish market. A bearish market with maybe some more pain to come. When you look at what institutions do in both lanes, multifamily and built for rent or single family, if you will, any guidance, any advice, anything that you would say, hey, here's what I see, here's what I've seen partnering with them besides growth markets?
Let me ask a question just to clarify. So
Sure.
what you're saying is like kind of like tips for partnering with institutions. Like what are they looking for?
No, we can get to that. I'm more wondering, what have you learned from observing institutions since you've been close to them? Or what have you mentioned you learned by, hey, the institutions go after growth markets. I'm going to go after growth markets. What else on multifamily? And then if you could on the single family side.
I am what I've seen is that they're like incredibly disciplined, you know,
What do you mean by that? Disciplined how?
disciplined in choosing locations and criteria around assets that they will or will not acquire, from a location, the makeup, the age, as well as like the return profiles, right?
Mm-hmm.
And if it doesn't check all of their boxes, they just move on. Sometimes a smaller or less institutional shop like my own
Sure.
um, might be willing to, well, yeah, but I really like this because I really like that because, right? So, um, being less emotional about buying a deal or that deal um, is something that I've become over time, and I see institutions being really great about like picking what their bogey is and only going after that bogey.
Mm.
Um, I think that's probably my biggest observation that I try to emulate from that perspective. The other piece is being really tight on their team and their underwriting. I talk to um, what you might consider as like a lower level analyst for an institution, and their acumen and ability to underwrite a deal and understand its metrics relatively quickly is very high. And so, fortifying your team with high performers, people who come from and have experience with what you need them to have experience with, rather than like hiring people that have potential and who could learn, is kind of something that over the course of the last handful of years that I've realized. My wife has helped me realize. She's like kind of she is in charge of organizational development for our organization. Is that pay for the high performer, pay for the individual worker or team member that's going to lift you up rather than the opposite, and
Mm.
elevate you in your operation rather than the opposite. I see that with institutions.
That makes sense. How have you? I know you've been asked this before, but if I'm sitting at my desk right now and I'm like, you know what? Wow, I want to partner with institutions. Like, what's the
Yeah.
first thing, second thing, third thing? Like, how do you start? You just call BlackRock or call one of the one of these places. Like, how do you build those relationships, or how did you build those relationships? What advice might you give there?
So like, just to be clear, we used to sell groups of single family properties to institutions. That
Yeah.
really helped me understand what a buy box was and what type of information an institution wants to look at when they're looking at a property. They were looking at single family properties at the time, but like validating your underwriting assumptions on
Mm.
paper with work papers in a very easy to follow, organized fashion folder structure that you can share via Dropbox or whatever other link. So it's like, I believe rents are here, and we believe rents are going there. We're buying this property for this, and we think we can sell it for that, right? Well, you need underlying validation to that. You need to show that similar properties are selling for that. You need to show that similar properties are renting for that rental amount, and be able to tie it together, right? This is stuff that a lot of us listening today, or a lot of you listening today, are like, duh, like, no kidding. But those are things that some of us didn't realize early on. We all start somewhere, right? So it's like, yeah, we
Yeah.
believe it, but we've got to prove it, right? So institutions expect that proof, right? You got to tie all of those assumptions together. I connected with institutions originally and continue to by going to conferences. A great conference that conference circuit that I have gone to from single family to multifamily has been IMN. IMN.org. They have a lot of great real estate conferences throughout the country. They're middle market focused, so like middle market being like the size of like what GSH is. And there's others. There's other conferences. There's plenty of conferences, plenty of good conferences, but they usually have equity folks there, right? And there's also equity brokers, right? I don't mind paying brokers. I don't mind paying brokers when I find a property or to help me find a property. And I don't mind paying brokers to help me find equity. You know what I mean? Because it's not coming out of my pocket. I capitalize all that stuff into the deal. So what does that mean if you're new? It means that when you're buying a property, you've got the purchase price of the property, and then you've got costs associated with purchasing the property and potentially also additional reserves for construction or whatever. And so your total capitalization is the price of you're buying it for, plus all these other expenses. Well, in my total capitalization, I budget for an equity broker if I'm using an equity broker or consultant or whatever that might be. And you can get to institutions that way. We haven't taken one institutional check since GSH has been around. Like I said earlier, but I've met different institutions. And look, when you think of an institution, like you said, BlackRock, Blackstone, right? You see the headlines and you think, okay, those are the institutions. And yeah, they partner with groups to buy multifamily, but the truth is that there are hundreds that you've never heard of of smaller institutions, funds, and family offices that also are very specifically focused on multifamily and have infrastructure set up to be equity checks for sponsors like us. Okay. And so you find those by going to conferences, by researching through LinkedIn, by talking to equity. If you have a relationship with a broker in your market, a national broker, a Marcus and Millichap, a Newmark, a Berkadia, like they're trading, they're selling deals to other sponsors who have these equity partners. You can ask them. A lot of these shops have equity groups now that as a service will try and pair you with, if you have a deal, pair you with potential equity. I see on GSH's growth horizon doing deals with JV equity check writers because we've created a really nice platform now, and we'll continue to do deals with our existing investors. And if we want to grow at a more exponential rate and really take advantage of what I feel is like a coming opportunity in the next few years, it'll be wise of us to partner up with some larger check writers.
Thank you for that. And honestly, even I think within GoBundance, right? You think about networking is essentially the core of it. There's a number of guys with family offices, right? So I know of a few that have family offices set up for their what they built, and yeah, a lot of them are looking for opportunities in these different sorts of asset classes. Right now, if you're starting out, or if you're sort of down a lane a little bit, you started in multifamily a couple of years ago, you built a small portfolio or whatever, and you're saying again, I'm ready to go, I'm ready to roll. And this could be anything. I don't know how much you look at macroeconomically, whether it's business acquisition, multifamily, office, which I don't think will be the one, retail, self-storage, single family. What's the next 5 years? I mean, you're in the multifamily lane. You've developed systems. You know it. Like you said, you're there, and it makes sense. You got $1 billion portfolio. You should stick with your lane. A great golf line, right? Safe line, aggressive swing. Stay in your line and swing aggressively. That's what you're doing. But if you don't have that line, I don't know what my line is. I've dabbled in a couple of these different things. Just curious. Is there anything that you've thought, man, if I were starting today and I had the ability to raise capital for raising for something, I'll be honest. I've said business acquisition. I think there's a way bigger opportunity in that space for service-based businesses, so on and so forth, to consolidate, build a fund around mergers and acquisitions. I know nothing of this. I sound really smart saying all of that. I know nothing about it. But for you, is multifamily still the play if you started again today? Or is there another asset class that you say, man, you know what? This really looks interesting to me.
That's a really great question. And I think like probably a lot of us, listening like you, I'm easily distracted by something that looks shiny.
Shiny objects, of course.
So like, yeah, I mean, like I would love to do some fix and flips on single family like that. it's funny because I can make so much more money buying and operating a multifamily apartment community, but I'm always, but buying a house and fixing it up and selling it real quick, like it has some nostalgia for me and has some excitement because it's different than what I'm doing every single day. Um, if I'm starting out, like you said, I probably am going back to single family because I think there's a bigger there's a more attainable dislocation, immediately attainable dislocation in single family right now than in multifamily.
What do you, what do you mean by that? Attainable dislocation. Those are big words, man. You got to dumb it down for me.
Sorry. So I believe that you can go out and find a property today that was worth 300 and now is worth 240,
I see.
right? Because of where interest rates are.
Yeah.
And you could probably buy it and freshen it up and sell it for somewhere in between. I believe that that's more attainable today. And I know that, there's some other GoBundance guys who do that all day long,
Sure.
um, and we have explored at GSH, um, branching out from just multifamily into other real estate verticals to chase yield, right? So as opposed to us just being multifamily, even though that will probably always be our core competency, branching out into other real estate related, like I said, verticals to because we've got this huge following of
Yeah.
investors now, so we've started slowly and we've done it through joint venture. We've looked into senior living. We've done a senior living deal. We've done some ground up. We're doing an adaptive reuse where we bought an old school administration building in Grosse Pointe and we're turning it into 18 units and building 8 townhouses. We're keeping ourselves busy. That's like a $10 million deal. We're raising $3.5 million for it. It's a small deal for us at this point, which is crazy for me to say, right? But we're doing that just to keep ourselves busy and to build our resume. We own a construction company that's doing the construction, so it's keeping things moving. Because maybe there'll be an office building that we want to convert at some point into apartments, and we'll have already done that in one way, shape, or form. You know what I mean? Um, Starting out, I would probably look. The easiest way to an investor's heart is through yield, and so meaning a good return. So what out there is generating the best return right now? I don't necessarily know if that's multifamily, right? I think that it could be dislocated industrial. It could be well located retail. Even though retail was a dirty word in COVID, retail's back, right?
Big time. Big time. Especially with good anchor gyms, services type tenants. Yeah. Medical.
I've had the same thoughts as you have also, Jamie, about, businesses. When I transitioned from single family to multifamily, there was a year where my wife and I, we went to the Dominican Republic like 4 times. We traveled a ton, visioning what is our next move, right? And I partnered up with a couple guys who were in that business private equity space. One was a CFO, one was kind of like a CEO for hire, and we looked into buying some businesses. And fundamentally it makes sense to me. You buy it, you make it, you increase the bottom line, and then you sell it. Just like it's the same as what we do in multifamily, right?
Yeah.
Obviously, I'm sure there'll be a steep learning curve, but I do believe that is something that could be in our future. Also.
I just think that multifamily, single family, I think there's an expectation that post '08, it being, us having a similar post '08 experience. And maybe I'm wrong on this, but I just don't think it's going to be quite the same. There's more people like anchoring in, holding on than there is, blood in the streets. There's going to be blood in the streets. There already is blood. I mean, I've talked about it before, 3,200 units foreclosed on in Houston recently, right? It's going to be there. But when you look at the business side, especially these, I don't know, a few $1 million a year businesses that are HVAC, car washes, laundry, even forget the car washes and laundromat, HVAC, management companies, things that you can integrate. There's a lot of owners that are tired, just like after '08. There's not a lot of people, not as many people fishing in that pond right now. Everybody's, focused on real estate because it's been a boom over the last 10, 12 years. Bigger Pockets has blown up. All these, real estate's gotten so sexy. Keep using that word. But businesses right now, you've got tired owners whose kids don't want to take them over. They don't know what to do with them. And your financing terms, the way in which you structure the deal is, I mean, it's the Wild West. You can do whatever the hell you want. You can keep them on for 6-8 months while you transition to new operational leadership. You can partner with their lead operator person who's not their kid to have some level of equity to run the day to day while you kind of stand behind it. So there's a lot of options there. I don't know. I'm convincing myself here. Businesses seem like a really.
That's okay. Listen, when you come back to Michigan, let's get together and talk about it, because I've had similar conversations, to be honest with you.
For sure.
And it's like, because I have a fiduciary to our investors on properties that are not going according to plan. That's my main focus. But as
100%.
things settle out, it's about putting the right people in place to run all of your businesses so you can continue to grow, whether that's grow your multifamily platform more, or get into other ancillary opportunities. That's ultimately my goals, the same as your goals, the same as everybody else's goals, right? What did we do when we were growing? We were doing a ton of capex, millions and millions of dollars a year of capex, construction improvements on our portfolio. So we started a construction company, right, to handle it all. Now that we've slowed down on acquisitions, we're going after more third party work in the construction company. We're doing a ton of flooring, and we met a great flooring guy, partnered up with him. Now we own a flooring company, right? And so can you create an engine that gives you ancillary opportunities, and then can you eventually work your way and build your way out of that engine so you're not spending as much time on it, and then you have the ability to spend more time, on the beach with your family or building more businesses, right? And so right now is kind of a tricky time, because I think a lot of us are really focused on fortifying what we've got, protecting what we've got, while being, mindful and looking at opportunities if they come. But as things settle out and the new normal happens, I think there'll be a lot of opportunities for what you're saying.
Yeah, that's smart. And you said it. You have the responsibility to what you've built, but as a human being, and I know you've referenced, I think many of us are similar. A pie in the sky. Always thinking of something else as just like ADD C+ student type of guys, right? Many of us are, because we're just always thinking of the next thing.
Look, you gave me credit for Syracuse, but like I'm that guy. Don't get me wrong.
Right.
My priorities when I was in college were a little bit different than just going to class all the time.
All of ours were. Mine was dropping out. I left. I was SUNY Oneonta. I didn't even finish. It wasn't for me. I wasn't a college guy. But I want to pivot a bit. So on that point about you being an entrepreneur, somebody who thinks big and is always kind of like chasing the next thing. I think you've talked about your wife being the opposite, sort of the, I don't want to say anchor in terms of pulling you down, but just keeping your head from floating too far away. And you've been coached by your wife, if I've heard that right. Talk about that. And look, I get our wives, often we end up, yeah, she was right. But in the moment, it doesn't feel that way. How do you allow yourself? What did you have to do to be coached by your wife to be consistent, or whatever it was you're being coached by her for? The key to life, it isn't money. It's happiness. And when you measure how happy you are, you actually become even more happy. Our friends at GoBundance, the Tribe of Millionaires, use a very specific tool to measure their happiness. It's called the Life Happiness Index. And you can have it too. Go over to GoBundance.com/LHI and take your Life Happiness Index assessment. You'll rate yourself in multiple categories on exactly how happy you are and get a custom output for you specifically that you can use in developing whatever goals you have for your life. GoBundance is the tribe of healthy, wealthy, generous people who choose to live epic lives. And the tool GoBundance members use at the base of all of that is the Life Happiness Index. Get out there and grab life big.
She has proven time and time again that her intuition is correct. She sees things that are not always on just the normal day-to-day plane. She's got a higher eye than I do often. I'm a visionary when it comes to growth, and I've got that drive in me that you just described. And what often happens for me, because I think that, having a daughter that has a diagnosis of ADHD, and me identifying with a lot of like her traits, I think I was undiagnosed. And so I have a lot of great ideas and thoughts and feelings, but they're jumbled up inside me. And I need assistance at times settling in, getting grounded, and getting those thoughts out on paper so that they can be actionable, organized, and then acted upon. I'm better today at doing that on my own through sitting quietly, meditating, journaling, and working through my thoughts. But having a coach to go through that stuff, put it down on paper so it's in front of me so I know what I need to work on for the next 7 days to achieve what I want to achieve is super helpful, because I can keep myself super busy with what I've got going on and not accomplish one new thing. I can keep myself busy all day today for the next 10 hours just on emails if I want,
Sure.
right? But if I don't, but then, continuously be frustrated that I'm not doing the stuff that inspires me. So my wife was, she's got a master's in organizational development. She was a executive coach for entrepreneurs. And I said to her at a certain point, like, hey, like, I need your service. I need your full-time attention. Um, and and so we got to it. And it was around the time when I was, my old partnership for single family was coming to an end, and we're trying to figure out what was next. We worked together that way and have continued to work together that way through GSH and building it up until last year. In the beginning of the year, I asked her to come on full time and help with organization, because we moved to Florida to the beach, a month before we bought our first property at GSH, and all of a sudden 5 years later we've got 7,000 plus units and two other companies and an aggregate of like 75 employees, and I'm not operationally minded, and nor do I have the patience often to deal with interpersonal issues and processes and things like that. And that's what she thrives on. And I said, I need your help. Like she is the complete yin to my yang, right? Like I'm always looking for growth and focusing on that. And she's able to keep the business grounded, focus on the team. We just, she came up with the realization that in this competitive market environment and transitory economic period, what are we going to do to maintain and attract high performers? Well, it's going to be our culture, and it's going to be how we treat our employees and how we take care of them. And she's completely come in and like turned around and created a culture at our organization. I thought that our culture was a great one because I was pretty easygoing, and people seemed to like me. What I didn't realize is that people have issues and might be afraid to bring them to me. Even though I'm what I consider a nice, approachable guy, when I say things, they carry greater weight than other people because I'm the one in charge. I didn't really realize that. Um, and I never really wanted to slow down to deal with issues. I just expected people to figure them out. That's not healthy, that's not a healthy work environment. So going back to your question, I'm sorry I went on a bit of a tangent, but like
It's okay.
it has been a process. If you ask my wife here, if she was here and you asked the same question to my wife, like there are still times where I push back. There has to be a healthy back and forth. Uh, my wife is often right, but when or if she isn't, she'll admit it. There's reciprocity there. You know what I mean? And I've just had to come around to the fact that, like you said, often I might feel differently or disagree, but in the end, she often is always right, because I don't know, if it's much higher level than women's intuition. Like she's got a higher vision, but it's a struggle at times, because I've got my ego involved, and I think I'm smart, and look at everything that I've created, and you don't understand. And for me, it's about her and our relationship, and then the business. And I have been able to create or attain more humility, not humiliation, but just to be more humble and realize that I don't know everything. I need partnership from that perspective, and she balances that out really well for me.
With ADHD, I think many of us would identify with either being diagnosed, undiagnosed, self-diagnosed with some form of what we call ADHD. I think ADHD can get obviously a bad rap, and I can imagine those who suffer with it, and maybe I do. The frustration is what you said. Maybe there's progress versus action, right? Or progress. I'm sorry. There's action versus progress. Right? Don't mistake action for progress. I'm running in place. I'm doing things, but I'm not progressing because I'm not doing the things that are getting me down the line. But at the same time, ADHD comes with hyperfocus when there is interest. Like, look at the business you've built, or the businesses you've built over time. Mortgage business to start, then you're in the single family space, now you're in the multifamily space. I mean, they've all scaled because of an ability with maybe ADHD to hyper focus. With your daughter, if she's diagnosed, how do you balance allowing, or how have you, or tips or advice? Because I think a lot of people have this struggle right now, whether it's truly diagnosed or not. How do you balance allowing or giving your daughter the space to exercise the superpower that she has with ADHD versus giving her the ability to be a little bit more focused, or not feel so out of control because of ADHD? How do you strike that balance to ensure you're not robbing her of her incredible creativity and focus, but at the same time, or maybe you haven't figured this out yet, I don't know, I'm curious if you have any thoughts on this, but balancing that with yeah, go ahead.
All I can do is share like my own experience. I'm not an expert, right? But we homeschooled both of our daughters for the last 4 years. We were living down in Florida. This fall, we decided to stay in Michigan. Business is so much bigger. The economy has shifted. There's some more challenges. Um, our daughters are older, needing more from us than we really could give. Not necessarily from an academic standpoint, but like friend groups, socializing, and we needed to be focused more on the business and our my wife and my relationship, and it just was time. It was a great chapter for us to be homeschooling, to be together in those years, and now they're back at a school, private school here in Michigan, um, and we with our daughter with ADHD, she's an artist, so she can get hyper focused and draw. She could do it all day long, right? And we encourage that. Once we got into more of a more formal school setting than the homeschool was, um, uh, it really came out. Trouble with just remembering assignments, doing homework. We never medicated. We never chose medication because we didn't want to stifle her superpower. She was a very unique soul and an artist, and we were afraid that we tried everything else. For a handful of years. Um, and eventually this year decided to ease into some of that and find a balance between something that's just going to help stimulate her brain so she's remembering things more but not taking away her passion to be an artist and things like that. And I think that we found that healthy balance for her this year. We were very much, I don't want to say we were against it, but we were not interested in it for a long time for our child. And it turns out to be probably the best decision that we made, in this past year, because she's thriving now. Um, and what we saw was that her inability, she really kind of delayed executive functioning, which is like remembering to do things, following a task, doing multiple things. Giving 4 tasks, she'd get stuck on the first, or maybe even forget to do it. She'd just be distracted and end up somewhere else. And it started hurting her self-esteem, right? Like, we never said you should do this, but it's frustrating, and then you get into the broader world, the school environment, wherever else, and where there's expectations that you're doing certain things, and chemically, naturally, she's not able to remember to do that stuff. That started making her feel bad about herself. What's wrong with me? Why can't I do this? We supported her. We've explained to her for a long time that it has nothing to do with her. She's got something going on inside her, um, and it has no reflection on the person that she is or how smart she is. She's a genius. She's got a genius level IQ. She can't remember to brush her teeth. You know what I mean? Like, so we did it. We started, we eased into medication, and now she's able to do both. So I didn't have that, but what I remembered was, like, in elementary school, I remember my teachers putting me in the back row and getting rid of my chair and elevating my desk, right? Because I couldn't sit still. And I got through it. I think that there was probably some shame and fear involved with me and my upbringing in terms of like getting me to do stuff. And it served me today. Um, but, I've had this inherent motivation to be a successful businessman and entrepreneur that drove me. That was my passion. That was my vision. It's not the same for everybody.
Let's I told you we may not go the whole hour and a half, but here we are on the doorstep of it. Let's wrap on this question, because you've talked about this a little bit. You and your wife did a I'll call it a vision quest. You traveled around and all of that. What's five? Well, it's a two-part question. What's the vision? 5 years, 10 years, whatever timeline you've given yourself for the vision for you and your family in the next 5 years, let's say. And what's the process by which you develop that vision? If you don't mind sharing a couple of tidbits on how you create vision for you.
I'm a talker, if you haven't noticed, so I'm going to try and keep it concise.
You're good, man. You're good. I enjoy this stuff.
Look,
I've had some 3-hour podcasts, so I could go forever, but keep going.
So it starts with, I think our kind of natural organic way of figuring out what our visions are. You know, we sit down, and my wife is constantly doing vision boards. Like we'll do some vision boards together. You know, cutting up images and phrases, words that of things that we want to have enter into our vibration, into our universe. And you know, we do it through my wife and I do it through constant and ongoing communication, the coaching. We're talking about where we want to be, where we want to go from a 5-year perspective. We haven't done it in a little bit of time, like for the family. In truth, we get busy too. For the business, which translates to the family, you know, the goal in the next 5 years is 20,000 units, right? And so we know where 7,500 units has elevated us and our family. So, you know, multiply that up to 20,000 plus units. And I think I don't want to like cheat myself or the system and say like it'll just work itself out to us and our family. But I think that we want to have more time, you know. So we had time early, post single family transitory period early on in the GSH evolution. As we've gotten busier and needed to really focus on and fortifying our not only just our portfolio, but our platform, our business that supports the revenue growth. It takes work, you know, like this perception of getting into real estate so you don't have to work. It's like careful what you wish for, because the larger you get, the more work it is. But I think that where we're on is the next evolution of that is that we're working a lot and hard in the business today so we can then elevate above again and work on the business from a growth perspective, which is a little bit like more fun and sexy, you know, I think in at least my mind. So it starts with vision boards. It continues with communication. We have to write down goals, hold ourselves accountable in a loving and non-judgmental way, knowing that it's okay to have really big, scary, hairy goals, but it's okay to also detach from the outcome, you know, because if I'm not detached from the outcome, then I can be really hard on myself and think that I'm not doing well. You know, the 5-year idea for me is like 5 years ago, my 5-year ago self would look at myself today and be like, oh my gosh, we did it. You know, we did it.
Yeah.
And myself today is chasing my 5 year from now self, saying like, I don't have enough, or I'm or maybe better, I'm capable of more, you know, and that's a blessing and a curse. So it's like, how do I handle it? You know, it's like, I'm doing great. I can have more goals. Let's go for it. Let's grow, but let's focus on today. Let's be grateful for what we have. Let's experience and enjoy what we've got through different experiences and relationships and connection along the way. And wherever we end up, you know, we're going to be okay. I'm going to be okay because I'm loved, because I've got a great support system. I've got amazing relationships, and I'm creating experiences with people that I love.
I love it, man. I appreciate everything you dove into today. What's the best way for people to learn more about you, about GSH? Where would you direct them?
Yeah, so check us out at www.gshrealestate.com. That's our website. If you want to learn more about investing, you can fill out a form there. I'm not really on here to be peddling for looking for investors, but you know, I look at a lot of the folks as part of your tribe. I think are peers probably of mine, and so my email is Gideon, Gideon @gshrealestate.com. If you want to create a connection, send me an email. All the things that we talked about future opportunities, like whether you're somebody who's looking to just invest, whether you're somebody who's looking to like JV, partner, connect, learn. I'm happy to connect with anybody and develop relationships to the best of my ability as my schedule permits.
I appreciate that, man. Thank you for that. Thanks for being on today. Thanks for bearing with my million questions. But this is interesting. Great overview of the market. Great overview of you. So I appreciate it. And yeah, we'll have to connect once I get back to Michigan.
Please do. That would be awesome. Yeah, this has been great. I appreciate the time, and thanks for allowing me to be on your podcast.